Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, February 3rd, 5:13 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida with the Big Show, the Friday edition of the Revere Market Insight video where we take a look back at the prior week, take a look ahead at key levels for next week, and update the world famous 21 over 21 leaders list. Let's get right into it. First off, state of the market. You'll notice that's uptrend only, no more caution. All five of the major indexes closed above their 200-day moving average, and we made it through the big tech earnings, made it through the Fed, made it through the jobs report, and we're still above all three time frames, above the moving averages on all three time frames that we track over here. Short term 21 day, medium term 50 day, long term 200 day, and leaders are acting fine. Uh, Good to see no removing caution up here. Doesn't mean that we will ever throw caution to the wind. We always have our stops in place. We always have our risk management process in place, and we always look to take only low risk entries in leading stocks and leading sectors and in the indexes. And as long as the trend persists, we'll stick with it. If things change, you'll hear it here first at Revere. So, what happened today? Well, the jobs report was very strong. Strong employment numbers are the one thing that Jerome Powell keeps mentioning during any time he gives any dovish thoughts out. The strong employment numbers are what give him pause about uh, relaxing on the fight against inflation. And extremely strong jobs report today. I did read a breakdown saying that it really wasn't that strong. It was all seasonal adjustments accounting for the big gain. All I know is how the market reacts to the headline numbers. Excuse me. And after some not so well received earnings by the big three tech stocks after hours last night, that's Amazon, Apple, and Google. We were going to gap down. We gapped down more after that came out. So the initial reaction was negative, and the dollar jumped strongly, and interest rates jumped strongly. So not the reaction that the market's looking for. But by the end of the day, it's looking just like a normal pullback. No significant damage done either to the indexes or to leading stocks. Let's dig into it. G6, our growth proxy composite down 1.4%, S&P down 1.04, NASDAQ 100 down 1.78, Dow down 0.4, mid caps down 0.7, Russell 2000 small caps down 0.7, global diversified 60/40 stock and bond down 0.95, in-house GROTECTION we were down 0.86. We'll hit the tail of the tape and go through charts of what's being dropped and added from the 21. So let's get right into it, and we'll start off with, as we always do, the big picture look at not at Microsoft, but at the index that is not most quoted in the media. They seem to have a Dow finish, but we know the S&P 500 is the broadest index that big cap managers are tracked against. And what we are looking at here is 3 days up off the ADMA and a 1-day pullback. Let's look at 60-minute. I broke this down this week as what's a normal pullback and what's not. This is a normal pullback after the break above Jerome Powell's, the Fed's 2 p.m. Decision to raise interest rates by 25 basis points, then his statement, then the Q&A where he kept talking about disinflation. The market really liked it, strong into the close on Wednesday, big gap up Thursday on the back of Meta. Good earnings report from Meta, and that carried over to a bunch of the big FANG stocks. Second big up day there, and then today the gap down, tried to rally in the morning. It was really a tale of two halves today. Rally in the morning, give it up, by the end of the day. But all in all, normal pullback after three strong up days. So let's go to the NASDAQ 100, which has absolutely been leading this year after absolutely lagging last year. Here's the gap up on Thursday after Meta. Here's the gap down and close below the low of the range. Not such a big deal still. You can see how strong Wednesday and Thursday were relative to recent action, and how we broke above this 300 level. And at this point, nothing to complain about. We're still a bit extended, could use a little more sideways action. And let's go to the Dow now. Dow just kind of moving sideways, relative strength the last 2 days, or I'm sorry, relative strength today. Uh, Harsh underperformance over the last 4 weeks, following really 3 months of outperformance on a relative basis, and that's just the flipping of the market tone from 2022 to 2023, where we've flipped from defensive areas over to growth, high beta, and some beaten down tech stocks and beaten down FANG stocks leading the way today, are leading the way this year. And if it persists, it'll carry the indexes higher. And if it stops persisting, we'll start seeing the equal weighted indexes outperform again versus their market cap weighted peers. And we'll see the Dow start to outperform. And we'll adjust accordingly depending on what we see. There's with sector rotation and strength and weakness among the individual sectors, leading stocks, and the indexes. Let's go to MDY mid caps. Again, normal pullback after three up days, and small caps also a normal pullback after three up days. Really don't have a whole lot to complain about today. Equal weighted NASDAQ 100 was down 2.1% versus the 1.8% market cap weighted equal weight S&P, down 1.2%, just a little bit more than the market cap weighted. So on a relative basis, they're still lagging slightly year to date, meaning versus their individual, versus their peers, the Nasdaq 100 and the S&P 500. Now, here's where the big change took place today. We talked about the dollar last night, and we talked about how it feigned weakness after Powell and then showed strength Thursday morning before kind of going sideways into the close. Big gap up today on the dollar after that strong employment report. As I mentioned, let's look at a daily chart, and the dollar is making an attempt to change its trend. You can see going all the way back here to the beginning of November, the dollar has been in a downtrend. We had one close above the 21. Now we've got one close above the 21 now. This is looking like a false breakdown on the Fed. From failed moves come fast moves in the opposite direction. That's what we're seeing in the dollar right now. This is a concern. It's not carrying over as much to the indexes at this point as it is to gold, silver, and gold and silver stocks, which absolutely got smashed today. So just like that's looking like a failed breakdown, gold and gold stocks are looking like a failed breakout from Wednesday, as they've now had two harsh down days. Let's take a look on some different time frames here. Here's the 30-minute on gold. You can see the false breakout, move down and reversal, big gap down. I mean, yeah, this is a change in character. There's no question about it. All the way down, though, to the breakout level. So going back to a month, so a month of gains have been wiped out in 2 days on gold. How about GDX? Again, a month of gains, starting with the breakout level at 30 here, have been wiped out in 2 days. It's 10%. It's not massive, but who likes to give back 10% in 2 days? When this failed breakout Wednesday afternoon, we added to our gold stock position. So just not happening though the last 2 days, and dollar strength and gold weakness persists. uh, the inverse correlation is persisting very strongly, and you can see silver breaking down below this entire range on the 60-month or the 60-minute chart, which goes all the way back to mid December. So, um, not good. Not good for the metals and precious metal stocks, and very clearly looking like a false breakout and now a breakdown on gold and silver stocks. We reduced our position yesterday. The reason why we didn't close it today is because we're sitting right on, bring up GDX, which is what we own, right on the 50-day moving average and the 30 breakout level. Now, very frequently, moves will pull back to the pivot, not normally after this length in time. But the 50-day moving average to sell when you're sitting on the 50 doesn't seem to make sense. It seems like it is the risk reward is at least for a bounce, possibly a bounce into the declining 21. If it fails there, that's where we'll pull the plug on it now. But from a risk reward standpoint, sitting tight with the small loss that we have, where it's less than a 0.2% loss in the 3% position that we have. So we're comfortable with that. That's gold and silver went through the dollar. Let's take a look at the VIX. The VIX uh, acted the way the bulls actually wanted it to act today. So we gapped down. The VIX was flat. The VIX started going up while we were pulling back, but then the VIX started pulling back while we were kind of going sideways into the close. So it ended up net, the VIX lower today by 1.6%, still trending below the declining 21 and 50-day moving averages. Again, we're looking for any change in trends that would indicate going from a tailwind for stocks to a headwind on stocks. And as of right now, we're just not seeing it in the VIX. Let's switch to bonds now. Bonds made a big move, rates up, prices down after the jobs report. You can see the gap down here. We broke above the 200-day moving average, sitting right on the 200-day and the 21-day here in BND. That's the broad bond index. Let's go to corporate bonds. Sitting right on the 21, down 1.15% today. Let's go to junk bonds, down 1% today. These broke out but again, these act more like stocks act than bonds act. We really monitor it in case there's a fear of a credit event. It shows up in junk bonds first. This is just sitting on its ADMA. That's fine. TLT, this is the 30-year, failed into the 200-day moving average, pulled back into the uptrending 21-day. Now let's go to yields. Start with the 10-year. Uh, Up 4% today, bouncing off the 200-day moving average and a close above the 21-day. And now let's go to the 30-year TYX. Bounce at 35, up 2% today. Reversed into the downtrending 50-day moving average. So as of right now, this is contained by the 50 and the 200. We need to see a little bit more reaction next week on it, but we went from the market appearing, let's go to a 60-minute chart on this, and you can see we went from the market thinking that the Fed might be taking a break. Note the breakdown in the yield below this 35.5 level. Uh, Possible failed breakdown now as we're going the other way, but we haven't broken out to the upside, which would go from the failed moves come fast moves, old Wall Street saying. But again, something we're keeping an eye on. That's actually the 30-minute chart. Let's bring up the 60-minute chart, and you can see false breakdown relative to that level, but not going all the way back to December 15th yet. So that's bonds. What's left? Bitcoin, BITO. We'll keep it on the 60-minute chart. Bitcoin down 2% today, so possible failed breakout there also. Okay, those are all the major indexes that we track in every video. Let's flip now to the tail of the tape. And let's see what's changed here. VIX still bullish below the 21 and the N50 day moving average, as I mentioned, down today. Fear and greed. This is ticked up to a 76, which is in the range of 76 to 99, the extreme range. So it's a lower end of the extreme range, but something to pay attention to because we haven't been in this area. This is a contrary indicator. The farther this gets to extreme greed, that is the opposite signal that we want to see. Fear and greed always a contrary indicator. Here's the AAII as of last Thursday. Changes. We still have more bears than bulls. So this isn't supporting this extreme level in the fear and greed index. Only operating under the bull case now. We got rid of the caution from the market state for the rally to fail. We would have to see a break of the 21-day exponential moving average to kick things off on the bearish level. As I said, news, a very strong jobs report, up 517,000 versus 188 estimated. Futures drop, dollar up, rates up, and then ISM came in strong too, to add a little more fuel to the fire that the Fed might have more work to do. Day count from up 3 to up 1 with a consolidation day, now 11 days above the 80 EMA and the 21 EMA, 20 days since the follow through day on 1/6. Expectations positive, normal pullback today. No violation of the support and resistance ranges that we're watching. As I said, it was a tale of splitting the day in half, higher lows and higher highs, strength in the morning, lower lows and lower highs, weakness in the afternoon. The only things that were up today were the dollar and yields. Oil started out strong, gave it up by the end of the day to finish with some relative strength, but still negative. 11 out of 11 sectors were negative today. The worst off gold and silver stocks and solar, but the worst of the worst, real estate, utilities, and consumer discretionary and ITB. That's builders that have been acting great. Possible some fear of interest rates higher for longer if we continue to see strong numbers out of employment or any other economic data that we might see. So there's a double-edged sword with the soft landing versus the hard landing relative to what the Fed decides to do with rates. Focus list, all of these that we own, they'll be discussed as part of the 21 over 21, but let's go over Apple, Amazon, and Google after their earnings reports. We'll take a look at those before we go into the pluses and minuses. But what we did in-house today, add a percent to Bros, add a percent to DT, and on the pullback by SPXL and TNA. TNA is small caps, SPXL is the S&P 500. Our index exposure now the equivalent of 45% or beta of 0.45 relative to 1.0 on the S&P. Overall at 1.1, which means 0.65 in individual stocks and sectors that we own. So that's how our exposure is weighted. Bottom line for now, normal pullback after 3 strong up days. Do have to monitor that dollar and interest rates after the move today on the strong jobs report. So let's get into, first of all, those big three. Let's get to a daily chart and we'll go through Amazon. This ended up being the loser on the day. You can see yesterday, despite the gap up, this was on meta strength. Uh, Failed at the 200-day moving average. And let's look at a 5-minute chart on this. So it initially gapped down like it did last night, tried to show some strength, but rolled over and closed near the lows of the day. So completely filling the gap. And this is looking like an island top here now on Amazon. Uh, Still sitting on the ADMA, harsh pullback in relative strength after showing strength since the beginning of the year. Let's flip to Google. Go to the 5-minute first. There's the gap up, gap down, and then it closed the gap, was showing extreme strength. Did pull back a little bit along with the market, but all in all, I'd consider this a win for Google. You can see here on the daily chart, gap above the 200-day yesterday, gap down under the 200, reclaimed it, pull back and closed right on the 200. We're monitoring all of these stocks versus the big 7 versus the 200-day moving average because they'll dictate the strength of not only the S&P, but obviously also the NASDAQ 100. And finally, this is a win for Apple after initially gapping down on earnings and gapping down, not gapping down, just really opening down to start the day. Immediate strength came in, going from 148 to 158 before 10:30, then just really sideways to gentle lower. If this is the worst that can happen to Apple after everything, they were lower on earnings, but they're or lower on sales for the first time in years. Blamed it all on the supply disruptions in China on the iPhone. So apparently, if they didn't have those, the thought or well, the theory behind the strength today was that if that's the worst that can happen to Apple after everything they dealt with in the fourth quarter, that's okay with us. Pulled back, bounced at the 200-day moving average, and very much made a higher high on double average volume. So Apple the winner, Amazon the loser, Google will call it a tie. All in all, on the NASDAQ 100 for the week, the winner up 3.35%, putting distance between it and the 40-week / 200-day moving average. So now let's get to the 21 over 21, and we'll start off with the losers, meaning the group that was kicked out this week on the 21 over 21 list. And some of these we owned. We'll start off with Caterpillar. We didn't own this one, but gap down on earnings, 2 days lower, bounced at the 50-day moving average. So right now it's capped at the declining 21 on the upside, capped at the 50-day on the downside. Monitor that to see which way it breaks. Could be that this is the bottom for Caterpillar with the gap off the 50-day. This is very similar to the way we're treating our GDX position, that the risk reward at the 50-day, and also the fact that it corresponds to that 240 level and the 240 pivot of this really tight base. A lot of support at 240 for Caterpillar. Next up, GDX. Broke the 21, sitting on the 50. We talked about that. First Solar, really poor yesterday. Second close below the 21, bounced near the 50-day moving average. We sold our position yesterday, and it bounced at the 50 today, but coming out of the list. OIH, bad day yesterday. Recovered most of it today, but faded into the close. Closed right below 0.6% below the 21-day moving average. Schlumberger and Halliburton also broke below their 21. So this has to come off the list, although we are still holding it. And Boeing, we sold half of our Boeing yesterday, closed 0.6% below the 21-day moving average, bounced at the 21 on its earnings report on that at 214.75. It should hold that. That's an inflection point. They reported earnings, failed to break out an attempt Wednesday morning, turned to selling, and they got a downgrade today. Now, the downgrade looks like somebody knew about this downgrade yesterday afternoon because it didn't gap down much at all on the downgrade and was working its way sideways, holding unchanged, which was actually showing relative strength versus the market, but did give it up from 209 to 206 by the close, coming off the list, but we still have a 4% size in this. Hasn't broken below the low of the earnings gap up day, the low there 203, but would have been nice for it to stick above the 21, but it just broke below it. So those are the 5 that came off. Let's start off with what was added. Those will be the first 5 that are on here. And as usual, if it's got a flag next to it, it means we own it. ELF. Don't like the way this stock treated us when we got stopped out below the 50-day moving average, but you can't ignore. We're driven not by emotion here. We're driven by facts and data. Can't ignore a 15% gap up on 356% when they blew earnings away and raised their guidance and made a day 2 higher high. So ELF looking really good. Added back to the list. Meta. We're monitoring this as much as a psychological measure of the market, with it being between 190 and 200, 200 being psychological as well as resistance over here from last May and June. So 200 is a big level for it. If the market's going to work and Meta's going to work, it should hold below yesterday's low at 180.16. It's 180 to 200. I'm sorry, not 190. to 200. Was showing relative strength today. It was actually up for most of the day before fading along with the market into the close. So Meta added and trying to rekindle the magic of their big gap up on monster volume back in 2013. The difference this time is the fundamentals are surely not there as far as what they reported this quarter. But if you look ahead, uh, 10% earnings growth in 2023, 20% earnings growth in 2024. Both of those recently upgraded. The PE only at 22. It's not an expensive stock at all when you look at the PEG ratio. Next up, Dynatrace. We bought this on the gap up, added to it today, and it closed at a 3-day higher high. We love seeing that. This is exactly how you want to see them react to the upside. It slows a little bit. It'll pull back, bounce at the ADMA. We'll keep our position and continue to be adding to it, but uh, this is just how you want them to act. And it was while the market was pulling back into the close, this was being accumulated. It went from 45 and a half into 47 the last hour and a half. And when we saw that strength, that's when we added to our position. TMDX, very strong, very small position in this we own. Anything closing at the highs, is good. Bros, we added to this today. It's now 4%. It had a negative reversal along with the market today. Still above the ADMA. No stock is broken if it's above the ADMA. Hoping for better action than what we saw today, but it's perfectly normal considering the breakout above the 200-day moving average here around 36, closing near 39 for the week. And let's see, 1, 2, 3, 4. Those were the 5 that were added. And so now these are on from last week. Big mistake I made this week with AI, talking about how ridiculously extended it was when I sold it on Wednesday. I sold it at 20 and change. Look where it is now, almost at 26. Now, I kind of have a rule that I try to stick to. The last sell of any portion of any position should be a defensive sell, meaning it should pull back and violate a level, even if it's just the ADMA that violates it. In this case, we had a small position. It was 1%. We had a 20% gain. We booked it, and it's proceeded to go up another 20% since we owned it. So the proper move would have been to get rid of half of it and see where the other half takes us after the ADMA catches up to it. In this case, this thing is um, AI mania, basically. Uh, no question about it. After the 127 move up, a very controlled pullback the next day, and then 4 straight up days in AI, all with massive volume relative to what was normal. This has gone from a thinly traded stock to an absolute go strong stock. These things end up usually pulling back harsh at some point, but I'd like to be in it when it to give me that harsh pullback to cop some of the additional gains that we left on the table and make a decision on a defensive sell and not always an offensive sell with the last piece of it. So something I'd change if I could, but I can't. So obviously we move on, we learn from it, we update our rules, and we try to stick to them. Tesla continuing to show strength after its earnings report. We still have a 1% position in that, and that's another one we should have added to. Shopify, 2% size on this, normal pullback today. Melly acting fine, kind of going sideways all week after the breakout last week. Minor relative weakness this week also. Netflix was higher most of the day today and pulled back, still acting great since it bounced off of the 8 EMA after its well-received earnings report. RVNC, this is just unbridled strength. Since this first move up, didn't even get to the ADMA on the pullback. Then it broke out and has continued to ride the ADMA higher. Not getting into this was the mistake. But we have 21 stocks on here. We can't own them all, but sometimes you'd look back and you sure as heck do wish you would have taken position in some of them. And this one very clearly is one I wish I took a position in. AEHR still own a small piece of this, acting just fine. XBI own an 8% position in this. Lower volume pullback day after 2 above average volume days up. This is acting great. Um, and let's hope it continues to act great. And despite acting great, it's really just keeping pace with the S&P 500. We really prefer to have something do double what the S&P is doing, but um, we're certainly content with just keeping pace with it and making money as long as the S&P is making money. Las Vegas Sands going sideways since its gap up on earnings after a nice run. Nike holding the 21. Pick pulled back a tenth of a percent. I mean, that well, actually closed right on it. That's basically a rounding error. Uh, Closed right on the 21. Has acted fantastic. Look at all these blue bars over the last month since this gap up on 1/6, which was the breakout day, the follow through day in the market. Great action sitting on the 21 now. Let's see if this can put in a bottom. GE continues to act great, riding the ADMA higher. Crocs continuing to ride the 21 higher. Lennar Home Builders. I talked about how they all ITB had a bad week today after the jobs report with the spike up in earnings. This is or in rates. This is very much rates driven. The theory and why these have been outperforming for a while is that the Fed was going to pause, but if that becomes apparent that they're not, then there'll be an issue with the performance of this stock. Mortgage rates dipped into fives for the first time in months, and we'll see how this proceeds down the road. Shift for payments gap down, good strength. Look at the this was on OPEX, why this had such a bad day that day. Three big up volume bars over the last 7 sessions. Down today, closed near the top of its range. Undercut reclaimed the ADMA. This is acting great. Payment stock. 5 continues to ride the ADMA higher after bouncing off the 21. That's what you want to bounce off the 21 to look like. It bounces, and then it starts using the ADMA as its guide, pulling back and holding the 8. So once you bounce off the 21, you shouldn't revisit it within a week certainly, and then you want to capture those gains, and that's not what we saw with something I showed earlier. I can't remember what the ticker was, but once you bounce there, that should be your visit, and you want to go. And if you're not going, it's showing weakness. That's going to wrap it. As always, like to hear from you. The email is don@revereasset.com. The phone is 855 Real Wealth. That's 855-732-5932. I am not going to get out of here without showing my favorite chart. Bear markets preserving capital. It's what we did all of 2022, down 12%, while the market at its low was down 27.5. Lagging the market at the beginning of this year. That's normal when you flip to a market that's under the 200-day moving average to one that's back to trending above it and bullish. We're getting positioned in leaders. If they continue to lead, they'll have outsized gains. And that's the playbook here at Revere. It's been successful, and we'll stick with it. So it's not how much you make in the market, it's how much of that you can keep. That's the backbone of that strategy, avoiding the big losses, participating in market uptrends, GROTECTION. Grow when the market's growing, protect when the market is bearish, and that's our mantra here at Revere. So now, with that, we will wrap up the week ending February 3rd. This is Don Vandenbord telling it like it is. Thanks for listening and have a great weekend.